The average Japanese household has never carried a balance on a credit card. Not because they can't, because the entire system was built to make sure they never had to learn how. That's not a culture thing. That's not some ancient wisdom about frugality passed down through generations of monks sitting cross-legged with tiny bowls of rice. That's institutional design. Cold, deliberate, structural design built by specific people at specific moments in history for reasons that had nothing to do with virtue. And once you see how it actually works, gear by gear, you're going to have a hard time looking at your own credit card statement the same way again. Start with the cards themselves, because this is where the whole thing quietly diverges from what you think you know. In Japan, when most people say credit card, they mean something closer to what Americans would call a charge card. You swipe it, you buy the thing, and at the end of the month, the entire balance gets pulled from your bank account automatically. No minimum payment option sitting there like a trapdoor. No revolving balance. No 22% APR quietly compounding in the background while you pay off a couch you bought 2 years ago and forgot about. The infrastructure that makes revolving debt profitable in the United States, the minimum payment box, the grace period tricks, interest calculated on average daily balance instead of statement balance, a lot of that simply isn't the default in Japan. You pay it all every month automatically because the system was built assuming you would. Not because Japanese consumers are more virtuous, because the rails underneath them were never engineered to profit off the alternative. Think of it like the difference between a highway with an exit ramp built into every mile and a highway that only has one exit 60 miles down the road and it's unmarked. Americans aren't bad drivers. They're driving on a road designed to make them miss the exit. And the tow truck company that profits when you miss it helped design the road. And if the idea that your financial habits are shaped by which buttons your bank puts in front of you instead of your own self-discipline, hit subscribe, because that's exactly what this channel is for. Now, back to the part that actually built this culture in the first place, because the cards are just the surface. In 1904, a journalist named Hani Motoko created something called Kakeibo. She was Japan's first female newspaper reporter, working in an industry that barely let women hold a pen, let alone a byline, and she noticed something that most personal finance gurus 100 years later still haven't figured out with all their apps and their spreadsheets. People don't overspend because they lack willpower. They overspend because they never actually see their money moving. So she built a ledger, a physical notebook divided into 4 simple categories: survival, optional, culture, and unexpected, where you write down every single transaction by hand, and at the start of each month, ask yourself one uncomfortable question. How much can I realistically save this month? Before you spend a single yen. Not after. Before. The saving happens first and the spending has to fit around whatever's left, not the other way around. That single sequencing flip is the entire trick. It sounds almost too simple to matter, and that's exactly why it works. American budgeting apps do the opposite. They watch you spend, categorize it after the fact, sort it into a pie chart, and then tell you, gently, apologetically, that you went over in dining out again this month. That's not a budgeting tool. That's a receipt with a guilt trip attached to it, delivered after the money is already gone. Kakeibo is still sold in Japanese bookstores today, over 100 years later, essentially unchanged, not as some nostalgia item shelved next to vintage typewriters. As a functioning system that households actually use, right now, in 2026, because writing the number down by hand creates a kind of friction an app notification simply cannot replicate. You cannot swipe past a handwritten ledger, you cannot dismiss it with your thumb and move on with your day. You have to sit with it, pen in hand, and confront the number in your own handwriting, which is a very different psychological experience than watching a number update itself in an app you barely open. But the ledger only explains the discipline. It doesn't explain where all that saved money actually goes once the discipline works. And that's where it gets structurally strange in a way most Americans have genuinely never had to think about, because nothing in the US financial system has an equivalent. A huge amount of that saved cash in Japan doesn't go into the stock market. It doesn't go into a 401k or an index fund. A significant portion goes into something the Bank of Japan actually has an official name for: Tansu yokin, literally dresser savings, cash, physically stored in the home, outside the banking system entirely, sitting in a drawer next to the winter sweaters. Economists have estimated the total sitting in Japanese households this way in the tens of trillions of yen, hundreds of billions of dollars, just sitting there, doing nothing, earning nothing, because after decades of near zero interest rates, putting it in a bank account didn't meaningfully beat putting it under a floorboard. 0% versus 0% minus the walk to the bank. Think about what that actually means. An entire generation looked at the formal financial system and concluded, correctly, based on real math, that keeping the system honest wasn't worth the effort of trusting it with their savings. That's not paranoia. That's a rational response to decades of a central bank pinning rates to the floor through multiple lost decades, multiple recessions, and a level of deflation that most American economists only ever studied in textbooks and never actually lived through. There's also a workplace piece to this that almost never comes up. Traditional Japanese employment still leans heavily on twice-a-year bonuses, in summer and winter, rather than the American model of a salary smoothed evenly across 12 months. That structure forces a different relationship with money entirely. You cannot casually finance a lifestyle around a bonus that only lands twice a year and fluctuates with company performance. You plan around it. You save around it. The entire Kakeibo system was built for exactly this rhythm. Irregular income, disciplined tracking, savings locked in before spending happens, and it's part of why the system spread so fast 100 years ago and never really left. And here's the part that turns this from a quirky cultural fact into an actual mechanism, the part most people watching this never connect. The money that does stay in the banking system in Japan flows overwhelmingly through one institution, Japan Post Bank. It's not a normal bank in the American sense of the word. It grew out of the postal savings system over a century ago, was for decades essentially state-run, and became, quietly, without most people outside Japan ever hearing about it, the largest holder of personal deposits of any single institution on the planet. Larger than JP Morgan. Larger than any American bank you've ever had a checking account with. Grandmothers in small towns depositing modest amounts into their local post office branch, multiplied by tens of millions of accounts, adding up to a pool of savings so massive it became one of the primary buyers of Japanese government bonds. Follow that chain all the way through. The government borrows money by issuing bonds. Japan Post Bank buys a huge share of that debt, and Japan Post Bank funds those purchases with deposits from the exact same households whose Kakeibo ledgers told them to save in the first place. It's a closed loop. The discipline at the kitchen table quietly finances the discipline, or lack of it, on the nation's balance sheet, and almost nobody involved thinks of it that way. A grandmother in Osaka writing down what she spent on vegetables this week is several steps removed, funding the Japanese government's ability to keep borrowing at some of the lowest rates in the developed world. Now, put America's version of this loop next to it, because the contrast is the entire point. The credit card industry in the United States doesn't want you to pay in full. It genuinely can't afford for everyone to. The entire profit model, the interest income, the late fees, the minimum payment structure depends on a meaningful percentage of cardholders carrying a balance every single month. Every design choice, from the size of the minimum payment due box to the timing of the statement, close date to the rewards points that quietly nudge you towards spending more than you would in cash, is downstream of that incentive. It's not that Americans are worse at math than Japanese households. It's that one system profits from you tracking your spending badly, and the other was built by a journalist in 1904 who assumed, structurally, that you'd want to track it well, and then built the pipes so that assumption held for over a century. If you're the kind of person who wants to understand the actual incentive structures hiding underneath everyday financial habits, not just this one, but the recurring pattern across markets, the Sketchbook Finance newsletter breaks down exactly this every week. More depth than a video can hold, delivered straight to your inbox. The link is in the description below, and it's free, which brings up the uncomfortable question nobody in American personal finance media wants to ask out loud. What would it actually look like if the institutions profiting from your spending habits were structurally prevented from doing so? And what would it cost the people who currently profit the most if that changed?